Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is CF Industries Holdings, ticker CF. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $17.9 billion, and the enterprise value is $18.2 billion. It operates in the chemicals industry, and we can see that they manufacture and sell hydrogen and nitrogen products for energy, fertilizer, and emissions abatement. So this is a producer primarily of hydrogen and nitrogen. This is a chemical producer. These seem like they would be highly commodity type products, and we'll see if that plays out in how their business model works. Now, return on invested capital is a useful metric to let us know a little bit how the business is performing over time. Now, what I'd like to see is 20 straight years of profitability, but that doesn't hold true with every company. What we see here is 4 years of losses in the last 20 years, and that is a little high for me. Once you get over more than one loss in the last 20 years, then you're starting to go from a high quality company to either an average or a cyclical company, and for me this puts it into the average category. An average company tends to have 3, 4, 5, 6 losses in a 20-year period, and so it's a company that I probably would say so far is not as high quality. Now, you do have some very high returns on invested capital during certain periods. Like 2008, they had a 52% return on invested capital. It's extremely high, and then they peaked again at 24% in 2012. Now, unfortunately, since 2012, the business appears to deteriorate, going from 24% to 17%, 15%, 7%, a loss in 2016, and then 2%, 2%, 3%, 2%, and 7%. So if this is truly a cyclical type business, then this would make a lot of sense. You have these maybe a period of shortage during 07, 08, 09, period of shortage in 2012, and then maybe a glut in 2016 and since, and that has probably caused this sort of pattern. This is what you would typically see in a cyclical pattern. It goes up and then down, up and then down, up and then down. And now you're kind of coming up again. But either way, the problem here is these numbers are still relatively low. They're all below 10%. Everything since 2015 has been below 10%, so that's not very good. You need kind of an acceleration to get back into this 15, 20% area if you want to be a successful business, for me at least, as a shareholder. Now, the 10-year median returns tell us the same story. You have a 5% average return on invested capital, 12% return on equity. This is starting to get better. I want this to be above 10%, and I want the return on equity to be above 15%. And so you're close, but you're just still a little bit too low to make it a workable high quality business for me. Now, with that said, the PE ratio is low. A PE of 11 is an attractive number that you'd want to see. So PE of 11 with 1% revenue growth, 0.7% revenue growth is something that could work out very well for shareholders. However, the problem is you need this to be both low capital intensity. They can't be reinvesting this money in the business because you're going to get a low return if you reinvest, and they need to be distributing a lot of capital to shareholders. If they are, then this is a fair price for this business. If they're not, if they are reinvesting, then this is probably still overvalued for their business. So that's how capital allocation is going to influence this. One problem you see here is that although revenue is growing at 1%, assets are growing at 3%, and that's causing this decline in return on invested capital over time. It's why you have revenue at $6 billion in 2012, revenue at $6 billion in 2021, and yet if I look down here at earnings per share, they have gotten worse. You had $5.72 at the beginning of the decade. Now you're at $4. So despite that, I don't even know how you're getting this number, because it says it's a PE of 10 or PE of 11, and yet the last close is at $86 per share. That doesn't really make sense to me, because you have $4.24 per share as this last reported number. So that's showing a PE of 20. So something's clearly not matching up here. Now, there are a lot of dividend payouts. You have $1.20. But again, that's not all the cash. So where's the cash going? Because really, that's where your return is going to come from. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe. Your subscription lets you know when I'm uploading new videos. If you ring that bell, that gives you that notification that I'm uploading new videos. I'm working through every company in the S&P 500, so stay tuned. We will go through your favorite companies either already or in the future. It's in this playlist. Now, the income statement, we can see a little bit more here. You can see that the fluctuation of revenue is leading to massive fluctuations in gross profit. And this is what is typical for cyclicality. So you have, even though the revenue is similar, from 2012 to 2021, you're getting massive difference in gross profit. You go from $3 billion in gross profit down to $400 million in gross profit, back up to $2.3 billion in gross profit. So these massive fluctuations in gross profit just kill operating profitability. They make it super cyclical. It's why you have a loss for these 2016, 2017 years on a pre-tax income basis because of those big changes. Now, one interesting thing is they're doing buybacks. And it looks like pretty significant buybacks, at least a 1 year here. So the prices are probably getting cheap enough that those buybacks are being very accretive because you were able to retire about 1/3 of the share count over the course of the decade. That's actually really, really good, going from 320 million shares outstanding to 215 million shares outstanding. So that's actually something that's very interesting to me as an indicator of positive capital allocation. Now, if we look at the PP&E, you can see that they have had to grow their PP&E about 2x over this period of time. So they've gone from $3.7 billion in property, plant, and equipment to $7.3 billion in property, plant, and equipment. So that's about a doubling over the course of a decade, and yet gross profit is flat. So that's a problem, and that's not what you want to be seeing there, and something clearly that they're going to want to address as time goes on, because that's not how you can run a good business over the long term. Now, let's see here. You see the debt has doubled, but it's still fairly low, 1.6 billion to 3.4 billion. Cash flow. PP&E, so they're spending a lot of money on PP&E, but it's not all of their cash flow. The problem is that some years they have actually really low cash flow, so they are outspending it on different years. They're having to take out debt in order to do that, or financing, depending upon what they're calling the difference between financing and debt here. So you have a pretty consistent dividend. So this dividend is only $280 million in cash flow compared to their $2.8 billion in cash flow here. So some of that has been going into net issuance of common stock, which is really, really good, but others in debt. So the problem is this is what you see from an average company. There's no clear picture here. There's nothing here that really does. It's like, oh, this is going to be a lot of my cash flow. Again, I wanted to see a bulk of my cash flow being paid in dividends. Bulk of it being in issuance of common stock, but you're not really seeing that. You are having to reinvest pretty substantially in PP&E. So for me, this is what I'd call just a typical average cyclical company. You have some really, really good years. You have some really bad years. If you can time these moves really well, then you're going to make a lot of money. And if you can't time those moves well, then you're going to lose a lot of money. But in terms of a long-term holding, it's not what I would look for in terms of a high-quality business. So for me, it's going to be a pass because I focus on high-quality businesses. If you enjoyed this video, please hit that like button. Don't forget to subscribe. I need your subscriptions to grow my YouTube channel, to grow and teach the YouTube algorithm that you're enjoying this content. So please give me that like, give me that subscribe. I really appreciate it. Until next time, stop paying fees, start building wealth.